Sequence of returns risk is one of the biggest hidden risks that retirees face in retirement. Two investors can have the same average annual return and have one person run out of money and the other person not. If you have the same average return, how come one person has more money at the end of a time period than somebody else? When you retire matters. So if you think about somebody who worked through the global financial crisis and retired in 2015, well, their experience as a retiree is pretty fantastic. They start into the middle of a bull market that goes on all the way through COVID. And I mean, if you exclude COVID, still kind of going on today. That's great. Markets are rallying, markets are going higher every year. You're taking out money. The experience is phenomenal. Contrast that with somebody who retired in 2005, 2006, or 2007, leading up to the global financial crisis. Those people have had a totally different experience, because if you retired and you're like, hey, great, things are going well. I've got all my money in Citigroup and Bear Stearns because they paid their dividend-paying stocks and great businesses and are going to be here for the next 100 years. Their experience was very different from the person who may have retired in 2015, because immediately they go into a global financial crisis where banks basically go out of business. Bear Stearns does. The S&P 500 having a drawdown of approximately 55%. The world seems like it's falling apart and is never going to recover. That is emotionally scarring, and a very different experience from somebody who retires in 2015. Sequence of return risks matters because once you flip the switch from I'm working and I'm putting money into my 401k to I've retired and now I'm paying myself and taking money out of my 401k, when you take money out matters. Once you retire, you can't exactly be like, you know what, I don't need to eat this month. I'm not going to take any money out of my 401k or out of my IRA or out of my investment account because the markets are down. You're still like, well, the utilities still have to get paid, the mortgage, if you have one, still has to get paid, and I'm pretty sure that I need to eat. Sequence of return risk, this is where it becomes really important, how you manage your distributions. Because let's take a look at an example of two people. We'll do like a $100,000 example of what sequence of return risks really means. Let's take a look at a really simple example. We'll do 4 years, 2 investors, 100 grand starting point each. Each investor will have a different return experience, but they're both going to have $100,000 and we'll take out $5,000 each year. We'll say, okay, to start, distribute $5K per year. What does that look like? Year 1, year 2, year 3, year 4. In year 1, investor 1 gets a 40% return, year 2 a 7%, year 3 minus 10%, and year 4 a minus 10%. So the average of that return is 7%. So let's go over to investor 2. We'll use the exact same numbers, we're just going to mix them up. In year 1, the investor 2 had a pretty rough starting year. He lost 10% in the first year, lost 10% in the second year, made 7% in the third year, but year 4 he crushed it, 40% return. 7% average annual return. So if you have $100,000 and you're taking out $5,000 a year, this is what that looks like. So after year 1, we're taking out $5,000 a year. But $100,000 with a 40% return grows to $133,000. Year 2, 7% return, that's $139,000 roughly. And then minus 10 in year 3. That gets you $118,000, a little more. Minus 10% in year 4. After taking out $5,000 again per year, that gets you around $102,387. That's your ending value after 4 years of taking out $5,000 a year with that return sequence. Let's look at investor 2. He lost 10% in year 1, lost 10% year 2, made 7% in year 3, but had a great year 4, 40%. Those numbers are, so after year 1, he's taking out $5,000 a year as well. He's down to about $85K. Year 2, he's down to about $72K. Year 3, he made some back, but he's still treading water, so he's still at about $72K. But then he crushed it, 40% return. Took out his $5,000, and he's at $94,440. So let's take a look here. So this 94, these are the two investor experiences with the exact same 4-year returns, just mixed up a little bit. The sequence of return risk here, the difference, is about $8,300, which is about 8.3% over the course of a 4-year period. So that means the sequence of returns alone, held constant, costs this person 8.3%. When we think about returns, it's not the average that matters, it's the way they occur, the order in which they occur that becomes really important. This is why we talk about risk tolerance and we talk about how we want to invest portfolios and how we want to diversify, because we need to minimize the potential damage that can occur due to poorly timed sequence of returns for new retirees in particular. Because remember, when you retire, you don't have this ability to wait it out or I'll just put more money into my 401k. You're stuck with the portfolio that you have, the money that you've saved, the wealth that you've accumulated, and you have to protect it and grow it regardless of really what's going on in the market and be able to distribute it out in a way that makes sense for you and in the things that you're looking to accomplish. So withdrawals during downturns, global financial crisis, COVID, those can be damaging in an irreparable kind of manner. So it's really important for investors to think long-term and think about how they can diversify in order to mitigate the risk that whatever goes on in the world doesn't necessarily impact their ability to live the life that they want and do it how they want. So there's a few ways that you can do this. The bucket strategy allows you to use funds for particular purposes, and you have some funds closer to cash for near-term expenses and stocks more aggressive for longer-term inflation fighting. You can also adjust your withdrawals lower if you go into a downturn, but sometimes that's not realistic. Diversifying is always a great way to reduce the risk of sequence of returns. It's not a free lunch, but it can help. Annuities can also help where that makes sense. There's a few ways that you can manage the sequence of returns risk. First, always start with a robust financial plan because that's going to help to simulate different future potential outcomes. From there, you can start to say, okay, if we were to have an economic collapse or another global financial crisis, what would you do? I would want to make sure that my required expenses are taken care of, and I would want to think about how can I safeguard those or bucket those into a way that allows me to be able to meet those needs. 2, I can say, you know what, I'm a little bit more risky. I can ride it out and I'll cut expenses along the way if things do get really rough. 3, I can try and diversify some of that risk away. I can use different types of investments. So maybe using treasuries or bonds or something that's less susceptible to economic risk. That would be another way that investors may look to mitigate some of the downside risk that comes with sequence of returns risk. It can also include things like options or other types of hedging vehicles. It could be structured products. Like there's a number of things out there that can provide some level of downside mitigation, downside diversification, which helps with that whole sequence of returns risk. The risk of starting retirement into a major down year is one of the biggest negative impacts. Sequence of returns risk, it's the hidden risk that comes with investing for retirees that we need to make sure is thought about and somewhat accounted for, because we don't know the future, but we can certainly try to plan for part of the future to have a robust idea of what are we going to do if and when the economy decides to go sideways or take a hit. We got to have a plan in place before we actually get there. Most people don't plan to fail, they just fail to plan. Creating a robust plan that accounts for these kinds of edge cases is really what can help provide long-term stability to your financial plan and help you get through those volatile market periods when you start to think, is this ever going to get better? And I think of conversations I had back in April of 2025 with the tariffs and everything going on. There was a lot of concern about what does this mean? Are we going into a recession now? The reality is we just don't really know what tomorrow brings. We don't know what the straw is that's going to break the economic camel's back. But we know at some point we're going to have a recession and a slowdown. So we need to be proactive and think about how do we manage through those situations so that way the risk of retiring into a drawdown is mitigated as much as possible. Because once you've retired, you've gone from accumulation mode where you're like, I'll just ride it out. I'll work another year. I'll put more money into my 401k. And you've switched back into, okay, now I'm taking money out and I need this money to live. So how do I make it last? And that is where this sequence of return risk really comes into play. The good news is this is where planning comes into play. We have a retirement readiness checklist you can download. If you have any questions, you can always reach out. And we're happy to go through how we think about this and ways we help mitigate that risk for the people we serve.